Hello guys, how's it going? How are you guys doing today? Good? Carlos, Tom?
I'm doing great. You
Everyone.
can
We're
see
doing great. Welcome.
Yeah.
Are we live already?
We're live.
Okay,
Yeah.
awesome.
We're live and we're waiting for everybody to jump in. Welcome everybody. Welcome to our analyst call. Very excited to have all of you today. Welcome, welcome. Well, the numbers is picking up again. Great.
Like the markets last month.
like the market. Indeed. All right, let's wait for the next minute or so and then we can get started. So I'm very excited today because we have a special session that would happen every end of the month, where basically we are going to bring our researchers from 21Shares to discuss about what happened within the month and what we are excited about or looking forward to for the coming weeks or so. This is on the back of our monthly reviews and over reports that we produced in the past. And I'm very excited today to have the first session of the year to discuss about what happened in January. All right, let's get started in 1 minute. Welcome, everybody. Welcome, welcome. All right, sounds good. So let's get started. Welcome, everybody. I'm Elyse Odinga, Director of Research at 21Shares. We have today our special guest, Carlos, Adrian, and Tom from the research department with me. Today, we're going to discuss about what happened in January, what were the key outliers of the month, and what we are expecting for the coming month. And last but not least, we have a surprise at the end of this call that we cannot disclose yet. So stay patient and enjoy the session today. So let's get started with Carlos. Carlos, what was the key outlier of the month that is going to set the stage for the coming weeks?
For me, the key outlier of the month was definitely Solana. We had a big month in terms of price performance, with most crypto assets with performances above 30%. But Solana was above 90% month over month. And this is especially important, in my opinion, because in November and December, when Solana was down really bad from the FTX and Alameda situation, and it was sub $10 in December, a lot of people were claiming that the chain was dead and that its prospects were really bad for the new year. And I think that its performance this month really shows that the ecosystem is still strong, and it has a thriving developer community. Electric Capital's developer report showed that Solana, among the ecosystems with more than 1,000 monthly active developers, Solana was the fastest growing in the past year, with a 74% increase year over year. And we know that developer activity is very important, and it's an early indicator of value creation in emerging platforms. So that was the key highlight for me.
And on the flip side of that, because you mentioned that Solana has about 1,000 developers on a monthly basis, can you also discuss more about the fact that not the majority of these developer count or full-time developers, right? So there is also between full-time developers and I would say part-time developers that basically try to fix the vulnerabilities or commit code to the Solana base less than 10 days a month, right? That's the definition of the report. Can you tell us more about like the proportion of the non-full-time developers in the Solana ecosystem?
Yeah, so Solana has around 383 full-time developers, which is about 18% of the total developers in the ecosystem on a monthly basis. So it has around 2,000 monthly active developers. But as I said, the majority of that, so around 82% of that, are people who commit code less than 10 days in the month. which could be interpreted in a number of different ways, as you mentioned.
Yeah. So how do you compare that ratio with the benchmark like Ethereum? Because Ethereum has a wider number of full-time developers. It's a wider net of developers committed to fix Ethereum or even build decentralized applications.
Yeah.
But how do we interpret that as investors to understand the future of Solana? Because at the end of the day, Solana is like an app store, and all the apps on Ethereum could be available on multiple app stores, the same way Instagram is available on the iOS and Google Play, right? So it means it's available on the iPhone and on Samsung. So how do we make sure that going forward, Solana could become a differentiated community and developer base compared to what we see somewhere else?
Yeah, so to give some context on Ethereum, Ethereum has around 5,700 monthly active developers, of which 1,800 of those are full-time developers. So the ratio of Ethereum's developers that are work full-time, it's about 32%, which is way above Solana's 18%. So the way you can interpret that is that the Ethereum community, the Ethereum core developer community, are more committed to the project in some regard. And I think that the Solana community has to work in this bear market environment to keep attracting new talent and keep shipping products that are differentiated from other chains, and that allows new developers to come in and stay as they see that they have a future on the chain.
I think it's a good segue to Adrian now, and also Tom. What do you guys think about how in the future any app stores or layer ones could become differentiated enough to outpace Ethereum? And of course, I want to know about your outliers of the month and what you're expecting going forward. But I think it's a good segue because I'm sure you have a lot of thoughts on this as well.
Absolutely, absolutely. I mean, at this current stage, I don't see any layer one outpacing Ethereum. But I think to establish itself as a prominent layer one, they might have to find a niche. So Ethereum, obviously, for me, is the number one when it comes to decentralization and its security. So it's a perfect playground for decentralized finance. But for Solana, for instance, a chain that is a bit more centralized, however, has a way higher transaction throughput, could be very suitable for gaming or for NFTs or metaverse applications. So I think for each layer one, they kind of need to find their niche and their use case specific. I think another example would be Avalanche. Avalanche with its subnets takes more the approach to be more like a traditional centralized player. We recently had the news that they are cooperating together with AWS to host their nodes, which is good for Avalanche, but kind of goes against the ethos of decentralization. However, I think Avalanche and subnets will be something that is focused on app chains. So like a hybrid between the private blockchains and public blockchains, and which will attract a lot of enterprises.
Yeah, I agree. I think it's a good segue as well for Tom here, for the outliers of the month. But on the back of what you said, Adrian, interestingly, today we've seen that a $12 billion fund is going to tokenize the securities onto the Polygon blockchain. I think it's interesting to see the war in real-world assets as well, where we could see that essentially the smart contract platforms are trying to also embrace traditional finance players. We've seen that with the Central Bank of Singapore tokenizing the Singaporean dollar alongside the Japanese bonds as well. And I think we're going to see that as well in the realm of CBDCs, so digital fiat currencies for the digital euro, the digital dollar, where essentially many central banks are going to look into public blockchains, how decentralized they are, how secure they are, and what kind of privacy optionality they have in order to make sure that the players building on top of the central bank can have, of course, the privacy that they actually enabled today when we're using traditional financial systems. So Tom, what was the key outlier for you?
I think my key outlier, I will first answer the previous question, which is the layer ones that will thrive with Ethereum. So I really do agree with Carlos and Adrian. So for Solana, I really see it is still having a really strong community, like the bond community, the airdrop, the bond token to the existing users, developers, so that the community can keep going. And I also see the developers are not just copying what is happening on Ethereum, because there are some really good developers actually shift from Ethereum to Solana because they really believe that Solana has a future. For example, 𝕂𝕂, which is the largest DEX on Solana, the developer and the founder is actually from Ethereum Foundation. And I think who previously worked in 𝕂𝕂, which is an oracle on Ethereum as well. So I think this is a really good indicator that Solana has really good developers, not just trying to follow the pathway of Ethereum, because of course Ethereum also has some restriction right now on the scalability, and therefore they can't really host an order book model DEXs, a really decentralized one. Previously, Solana has Serum, but now we have seen that it is heavily backed by FTX. So the community see this opportunity and get rid of FTX, and they built a new fork, which is called OpenBook, which is still running and supporting different DEXs right now. And therefore, I feel like Solana can still continue to thrive, especially we flush out the toxic, right? Because previously, people are slamming on Solana because it is a PC blockchain heavily centralized by different huge entities. But now the toxic is out. So I really see Solana can continue to thrive with Ethereum. And another will be Cosmos, which is similar to Outlier subnet, which is a app chain thesis. Is, you know, DYDX previously was one of the largest perpetual DEX on Ethereum ecosystem, which is built on StockX. But now they've decided to move to Cosmos to become their own app chain, to decentralize their order book perpetual trading. So I think app chain can still continue to be a new thesis that could thrive with the Ethereum ecosystem. And the key outlier, I would say, is DYDX, even though it's a more low cap token. Because DYDX recently, they announced that they will move their token unlocks from March to December, because a lot of people are not buying DYDX token because of the huge unlock, which will release around 200% of the whole circulating supply to the market. That freaks a lot of people out. But then they now decided to move the token locks back to December, which relieves the market. And recently, they also share some statistics they have processed around 400 something billion in 2022, which is a huge amount compared to DYDX competitor like GMX and Gains Network, I think, a G-Trade. So it is definitely a really bullish momentum for DYDX, because once they shift to Cosmos to build their own app chain, it will provide more utility for the DYDX tokens, such as revenue sharing, because right now when you're doing on StockX, there's not much utility there. So therefore, it makes sense why DYDX become a key outlier in this month.
I think it makes a lot of sense. I agree. And to me, when we look at the overall ecosystem, what matters the most is understanding how differentiated the applications that we see built on blockchains or compared to traditional applications that we take for granted today that we're using on a day-to-day basis. And I think down the line, we're going to see more and more crypto native applications having their own niche and being so differentiated for basically enabling access to assets, access to financial services that would not have been possible in the past. It would be the same for media, etc. So I think going back to understanding how crypto fits into a diversified portfolio, given the fact that what happened last year, it was the worst year for bond and stock investors in more than 200 years. This is something that our parents, grandparents, and great-grandparents never actually experienced before in the market. So how does crypto really fit into this current environment, given the fact that probably we're going to have a soft landing of a recession, or maybe not, or we're going to have contraction again of the economy if we have a 25 basis point interest rate hike, or 50 basis points. I don't think we're going to have 50 basis points, by the way, but I think it's good for the audience here to understand, especially for you guys, explain how really crypto can evolve going forward in a market that it never experienced in the past, right? Where essentially in the past 10 years, we had a tech boom and very low interest rates. And essentially it was the perfect environment for alternative assets alongside growth stocks. So how do you see and perceive the coming weeks and months, given the fact that we know potentially today we're going to have, given the Federal Reserve is meeting today, we're going to have another hike for interest rates, but how do you expect crypto to evolve going forward? Because we know that given the institutional adoption, we're not living just in a bubble. The correlation between Bitcoin and SPY for the equity market in the US has declined significantly from the peak of last year in May when Terra Luna collapsed. But how do you see that evolving? Adrian, maybe you want to start?
Yeah, absolutely. I think on a fundamental level, the innovation won't stop in crypto. I think what we've seen last year was actually good for the long run. We've seen a downturn of Terra Luna, 3AC or FTX. And I think it's healthy for the state of crypto in general. Going forward and how it could fit in a portfolio, I think no one's ever talking about an oversized allocation to crypto. It should be a small-sized allocation within your alternative assets, because the upside potential and the disruptive power of that technology is just so powerful, in my opinion. The beauty is obviously it has been very correlated to the stock market, but what we've seen in the crypto market, it's expanding horizontally. So what I expect going forward is that we see a decoupling of crypto assets between each other, meaning we see narratives and themes within the crypto space. And I think that's where the potential lies.
I think it's interesting because right now many countries are trying to diversify away from the dominance of the dollar, right? And that's why we've seen significant inflows into gold products since 1971, something like that, which is really impressive. It's been a decade-long process to get to that level again. And I think it would be interesting to see how that would benefit to some extent Bitcoin. Given the fact that basically over the past 300 days, Bitcoin has never reached again its 200-day moving average. And now it crossed again the 200-day moving average about 2-3 weeks ago. And that took like 362 days to reach that level again, which is basically more than $21,000 per Bitcoin. The last time that happened was in 2019 when the price of Bitcoin went from $3,000 and $4,000 and going into stages essentially for 3 months until April 2019. And I think what is interesting as you're showing here, Adrian, is how that pattern is going to repeat again, given the fact that we're not in the same environment, right? Where essentially we have an environment where clearly the interest rates are a lot higher and there is heightened geopolitical conflicts where we see the conversions between crypto and humanitarian needs to the people affected by the fact that they're experiencing a war or a significant currency debasement, as we see in Lebanon and in Venezuela, where US dollar stablecoins are very attractive. I think, Carlos, you can talk more about this here. What would you expect for the next month or so, especially in the past bear markets? In my experience, we've seen Bitcoin leading the rally and then a reallocation into Ethereum and alternative assets. Do you think that we could see the same thing as well? Or you're going to see an allocation into stablecoins given the heightened geopolitical conflicts and currency debasements, where stablecoins may be more attractive?
Yeah. Well, first, I would like to talk about what you and Adrian mentioned previously about the high correlation between Bitcoin and the SPY and traditional equities in the US last year. I think it signals that crypto has matured as an asset class, and it really tells you about the type of investor that had been allocated to Bitcoin in the past year. And in my opinion, it also signals a misunderstanding of Bitcoin's value proposition, because at a fundamental level, Bitcoin should not be highly correlated to stocks. Essentially, Bitcoin is positioning itself as a non-sovereign form of money, and that has nothing to do with equities. So I think that even if we have a macro downturn, fundamentally, Bitcoin should not be highly correlated to stocks. And as you mentioned, the central bank purchases of gold hit its highest level since 1967. And I think it could be just a matter of time until we see some inflows there for Bitcoin. And regarding what you mentioned earlier and what I expect in the following weeks and months, as you said, Bitcoin has crossed its 200-day moving average. The last time it spent that long below its 200 moving average, as you said, was in 2019. And to give some figures, after it happened in 2019, it soared 165% from almost 5K to 13K 2 months later. And coincidentally, on the same day that Bitcoin crossed its 200-day moving average, it also broke above the 1 mark in its market value to realized value ratio. So I really like this on-chain metric. Market value, it's essentially just the market cap of Bitcoin, while the realized value is just the cost basis of supply. So the last time that we crossed the 1 mark on the market value to realized value after being below it for so long was on March 2020, before the previous cycle's bull run.
So maybe here you can break down the formula a little bit for the audience. When we talk about market value to realized value, essentially market cap, as you know, is basically the number of Bitcoins out there. So more than 19 million Bitcoins already admitted to the market since January 3rd, 2009, times the current price of Bitcoin. But what about the denominator of that formula, which is the realized value? So maybe tell us more why the beauty of the blockchain transparency helps us as researchers, but also for the investors to understand how undervalued or overvalued Bitcoin may be.
Yeah, so basically the denominator in this case, so it's just a multiple, as you say. The numerator is just the market cap of Bitcoin, while the denominator is the cost basis of Bitcoin supply. So it really tells you about the profitability of Bitcoin's investors from a certain perspective. And you can see that historically, most Bitcoin investors were underwater in 2022, especially in November and December, when it reached levels not seen since the bear market in 2019. And you can see from this chart just visually that values below 1 had preceded past cycles bottoms, while values that are really, really high have coincided with market tops. So obviously, past performance is no assurance of future performance, but what we can derive from past patterns is that Bitcoin has passed one of the worst stages in the bear market. It's potentially shaping itself for a rally. The question is it going to be a dead cow bounce, or is it going to be sustained, right?
On the back of what you said, when you can see on the bottom right of this chart, you could see that Bitcoin at some point in 2022 actually went above 1, right? Towards the end of 2022. And that was around August, actually. And that was because of the fact that we didn't have yet the FTX collapse. So I think there is still a lot of headwinds that the industry may face. We know that the bankruptcy of Genesis has been priced in, right? They filed for Chapter 11 of bankruptcy. we're still waiting for understanding and having a clear picture of what's going on with digital group, currency group, because at the end of the day, for us, we want to understand how they're going to move forward with the promissory notes that they have for Genesis. But I think like when, Adrian, you look at the 7-day moving average for next to resolution, you have the SMA with 0 days. If you put that into 7 days or 30 days, that basically smooths out the noise a little bit as well. And also helps to see how that basically pertains to previous bear markets, or even the 30-day moving average is also telling a lot on what's going on behind the scenes, because we're still below zero basically if we're looking at the 30-day moving average, just to smooth out basically the large swings, because the asset class is quite volatile, especially when we have moments that we've seen in November. But I think what is telling here is that the current price movements are also great things for Bitcoin miners. But even beyond Bitcoin and beyond Ethereum, I think it would be interesting as well to hear your thoughts on what is also going on outside of Bitcoin, outside of Ethereum, that you find very exciting and that would set the stage for the coming weeks as well. Because as you know, the asset class is fast moving, and there is much more than Bitcoin and Ethereum. Interestingly, of course, the Bitcoin dominance increased by about 10%, I think, like over the past month. But what are you excited about outside of the industry, especially for Bitcoin and Ethereum, outside of these two ecosystems?
I mean, on the back of Solana that we discussed at the beginning of our analyst call, it might be a controversial view, but I believe there will be a narrative for Rust-based alternative layer ones. So the same story that we've seen like, 1.5 years ago with Ethereum and all the so-called Ethereum killers. I think we're going to see something similar for Rust-based layer ones. Solana had its issues in the past with a few outages. And also with the FTX debacle, but obviously they now kind of saved themselves. But I still think there will be this narrative of Solana killers. So if we look at Aptos, for instance, I think Aptos is also up over 300% over the last 30 days. And at the same time, it will be Sui or Radix, which are also alternatives. I believe we see some developers looking for a new, more promising or a new, more upcoming and trendy alternatives to Solana, and we could see some brain drain.
I think
what's your opinion on that?
The counter thesis to what you just said is that we could also see essentially the developers being attracted to the largest user bases because they want to have quick wins in a bear market where users are more, I would say, staying at bay of new developments because they don't want to run into a hack. They don't want to, of course, make sure that there's no liquidity in where they want to basically poke around with new applications. So I think it would be a counter thesis as well to what you just said, but that's possible that we could see brain drains in these new ecosystems where it's possible to build faster applications. But I think it would be very important to understand in the wider picture how does the institutional adoption is moving along onto these new ecosystems where it's not possible to build these solutions on Solana, because at the end of the day, the differentiator would be how sticky is the user base going forward, and not, as we've seen with Optimism, for example, a scaling solution where we've seen a huge decrease in liquidity in the aftermath of their token program as well to attract more inflows. So I think it would be interesting to see how central banks or even private banks are trying to basically tokenize real world assets onto these new layer ones. Because as we've seen, in the early innings of like Bitcoin and Ethereum, there were always like a lot of competitors trying to really catch on that narrative. But at the end of the day, they were a clear winner in the early stages of Bitcoin and Ethereum, and it was clearly Bitcoin and Ethereum to come out stronger than ever thanks to the network effects benefits that they were able to galvanize. And I think we're going to see the same as well for anything outside of that. Because I think like for the past 10 years since I've been in this industry, we've seen that the industry is really focusing on building the infrastructure. The same way from 1991 to 2001, basically, or even before 1991, actually since the AppNet in the 1960s, basically we had like a 30-year trend to build infrastructure for the internet, right? And up until 2001, we started to see basically bandwidth and 2G, 3G, 4G that enable basically the rise of mobile apps. And I think we're basically at the same stage as well, where now in crypto, we're focusing on the infrastructure to make sure that blockchains are more scalable, they can interact with one another. But at some point, the narrative is going to switch to anything that is more consumer facing, that our kids and grandkids are going to take for granted without knowing that they're using the blockchain technology. And I think right now, this is where we are, where essentially blockchains are a lot more efficient compared to the Visa network, especially for the layer 2s. The Visa network processes about 2,000 transactions per second. And now, for example, on StockNet, it's possible to process more than 2,000 transactions per second on that specific environment. Then you can make the case of like, is it decentralized, decentralized? But I think like showing the efficiency improvements by 10x, 20x, 100x over the next few years is going to be very important. But for the next month, I would agree that some narratives may be interesting in this bear market. But for us at 21Shares, we want to make sure that this is long lasting so that there is a thesis that is formed and then that can drive, of course, some interesting innovation on our side. What do you think, Carlos?
No, I completely agree with what you just said. And on the back that what you were saying, that people in the future will know that they are using crypto as a technology, right? They'll just be using another app. And I do think that some dApps are going to gain traction in the coming weeks and months. For example, we have liquid staking derivatives, apps such as Lido, Rocket Pool, and even Frax that has ventured into that space. But we also have other apps such as, for example, 𝕂, which is a decentralized lending platform on Ethereum. Recently, one of the most popular wallets in Latin America, in Argentina and Brazil, called Lemon, integrated 𝕂 smart contracts into its wallet so that users can interact with the app seamlessly without leaving the wallet interface. So that's just one of the examples of how you can improve user experience to potentially increase crypto's reach to a whole new audience. For example, this wallet has 1.7 million users in Argentina and Brazil. So that's just one example of what we can see in the coming months of trying to smooth the user experience so that it's easier for mainstream users to basically benefit and use crypto products.
And also you mentioned liquid staking. I think we can take a step back and maybe give some clarity to the audience as to what is staking, first of all, and most importantly, make the difference between staking and lending as well.
Yeah, so proof of stake, just going back a little bit, proof of stake is a consensus mechanism, same as proof of work. The difference is that in proof of stake, there are no miners validating the networks and using computationally expensive resources. In proof of stake, a validator has to commit a portion of their crypto capital, which is called the stake, in order to be able to validate transactions and confirm new blocks on the network. So the traditional problem with staking is that validators have to lock their capital in a smart contract. And so it's a very capital inefficient process because different networks have different staking requirements and staking rules. So for example, in the Cosmos network, validators have to essentially lock out their funds for 21 days before they can withdraw it. And for example, in the Ethereum network, withdrawals haven't been implemented yet. So if you stake Ethereum as a solo validator, you cannot withdraw that Ethereum. So liquid staking is really a solution to this capital inefficiency problem. And what it allows you to do is it allows you to unlock liquidity in a previously illiquid venture. So it gives you, for example, in the case of Lido, there's a derivative token that is called Stake ETH. So Stake ETH accrues a portion of the staking revenues from Lido's validators, and it trades on the secondary market. So you can so it becomes liquid and it accrues part of the validator's profits. So that's basically what liquid staking is.
Yeah, absolutely. And I think I would say that staking is a very efficient, I would say, way of earning yield in crypto. I wouldn't say it's inefficient. I think it's efficient in the way that essentially, given the fact that there is liquidity constraints at the moment on Ethereum, doesn't mean that it's an inefficient way of building, I would say, a mechanism to validate and secure the network, right? Because at the end of the day, in order to enable blockchains to process transactions every 10 minutes, like for example on Bitcoin, basically they need to be decentralized and they need to have operators around the world to agree on which transactions need to go first to the network every 10 minutes. And the way to do this is to make sure that the rules on the network encoded to the code or basically agreed upon across the world without anyone trying to change the rules based on their own preferences. And that's why there is on the other end having a machine doing that, or on the other hand is having essentially just capital allocated to the network in order to enable the unlock of the tokens. And I think that's interesting because staking is a significant narrative going forward, especially with sustainability friendly investors looking to understand the carbon footprint of blockchains across the world. Of course, 90% of the blockchains in crypto are proof of stake. So by design, they are essentially, they have the carbon footprint, I would say, that is more very low compared to what we could see with proof of work. But I think with proof of work, what is missing today is the fact that we don't have enough data to understand the carbon emission of Bitcoin miners, because a lot of them are using geothermal, wind energy, or solar energy, but there is no essentially like real-time database to see that. And that's an interesting area of, I think, research that needs to be exploited. But I think on the back of what you just said, I couldn't agree more for sure. Carl, Tom, what do you think? You're on mute.
You're on mute. Yeah.
Sorry, I totally agree with Carlos about the liquid staking derivatives, especially on the back of the Shanghai upgrade is going to be around late Q1, around March to April, hopefully. So if that's going to happen, currently the staking ratio of the Ethereum network is sitting at around 14%. However, compared to other networks, proof of stake network like Cardano, they have around 70% staking ratio. So if the withdrawals is going to happen or enabled, I think that it will potentially help the network to become more resilient, because it should be potentially attract more investors to stick the Ethereum into the Ethereum network, be it becoming a solo validator, directly staking it, or using liquid staking derivatives. And potentially, it could also benefit the liquid staking tokens and liquid staking services as well. For example, like as Carlos mentioned, we have Lido, Rocket Pool, and also even some centralized exchanges also providing these liquid staking services like Coinbase. So they are actually taking a larger cut compared to Lido or Rocket Pool, but then it's easier for users to use it, and therefore they still get a lot of traction on that. And I also do agree with Adrian, because obviously the numbers are speaking for themselves. Alternative layer ones, which is heavily backed by VCs, Aptos have risen really a lot. But however, we also should be considered the risk behind that, because the circulating supply of Aptos is really small, around 15%, and therefore it could potentially be manipulated easily. And the price is definitely really volatile. It could be potentially pushed up or pushed down by a certain whale if they decided to send the tokens into the centralized exchange.
Go back to what you just said, Tom. Essentially, for the investors looking at crypto assets, because all of them have a monetary policy and the circulating supply of the tokens, it means that looking at the token structure is to the utmost importance to understand how decentralized is the supply towards the community compared to the founders and the investors, and most importantly, how the unlock of the tokens is going to basically impact the secondary market. Right? Because in the primary market, the tokens get issued by the project or the foundation or the company behind it, or a handful of developers behind the protocol. And understanding the nuance of the supply is to the utmost importance as well, so that people can understand the liquidity constraints to some extent. Agree. So we're almost at time, guys. It's been an amazing conversation, and we already received some good feedback in the chat. But I think we have a surprise to show the audience. We had a couple of people already leaving, unfortunately, because they had to go on meetings. But Adrian, don't you want to show the new
I think I
magazine?
accidentally spoiled it a little bit, but yes, definitely gonna share it now.
We spoiled it a little bit. It is true. It is true. But we are excited today because we released our new magazine on Market Outlook, looking at the entirety, almost the entirety of crypto industries and sectors to give you a holistic understanding of what happened in 2022 and what we're expecting going forward. That's a long magazine of 76 pages. We try to be as concise as possible because, as you know, the industry in the crypto asset market is very similar to the software as a service industry, and we couldn't be more excited to show you some of the illustrations and content that we published. So stay tuned because you're going to get a copy of that, at least the link to get a copy of the magazine after this call. You're also going to get our last monthly review and newsletters. And of course, if you have any questions, feel free to reach out. But we are very excited about this one. Maybe Adrian, you can scroll down and show.
Yeah, I want to show some of the illustration also. Obviously, the content is amazing, but we're very proud of our illustrations. So big shout out to the graphics team. But look at this, for instance. We see here the illustration of a layer 2, basically a side road on top of the actual highway that is faster and more efficient. So there's a lot of little secrets like that in our magazine.
Absolutely. It looks amazing. Couldn't agree more. So we have a couple of questions. Number one, it's not a question, it's a comment. Congratulations, very good presentation. Well, bravo, guys. Very good feedback on that. Another question is, do we think that tokenization of real-world assets will be a driver for the new wave around the whole blockchain industry? People are still struggling to understand the real benefits of asset-backed tokens compared to traditional investment solutions. For example, real estate investment funds, shares compared to tokenized, REITs. Maybe Carlos, you can give more insights into that. And I think what I would say here before you start is we already have the best example and a strong product market fit with, I would say, one of the most important mass adoptions that we've seen in crypto with asset-backed tokens, and that is US dollar stablecoins. We see billions of dollars of transactions on a monthly basis and trillions of dollars settled on a yearly basis as well, which is very impressive. For example, Tether had more settled transactions compared to PayPal in 2022, and that is very impressive. So fully collateralized US dollar stablecoins are the first, I would say, guinea pig of what is possible on the blockchain. And there is a strong need for that because most of the crypto assets are free floating currencies and they're not backed by a specific asset in the real world. And that's why in emerging nations, as we've seen, for example, in Lebanon and in Venezuela, there is a strong need for having access to dollars. The same way we've seen, in the 90s and 80s, the dollarization of many countries because of a failed local currency. We're definitely seeing that because people now, with technology, especially in emerging nations, they have more mobile phones than bank accounts. And there is basically like more mobile phones per head than bank account per head in many continents, like for example, in Africa and Latin America. And having access to essentially a wallet, and on top of that, of the wallet, there is US dollars, makes it a strong use case for remittances. And that's what we've seen, especially in these places. But then again, we're seeing that as well. There is tokenization for private equity funds. But maybe Carlos can give more insights into that as well on the back of what I just said.
Yeah, I completely agree with what Ellie says. Stable coins are definitely the original real world asset, and in my opinion, the most important innovation that has come out of DeFi so far. I think that in crypto, people tend to have a very US-centric or Europe-centric point of view, and forget about the benefits that crypto can have on underdeveloped nations and emerging markets. So on the back of what you were saying, Ellie, for example, Argentina and Venezuela have inflation rates of 114 and 79% respectively. So stable coins for these populations have really been the means, at the last means to escape from local currency debasement. And you can see that stable coins really, especially those back to the US dollar, really have product market fit, not just in Latin America, but as you mentioned, in Africa and Southeast Asia. Regarding other types of real world asset tokenizations, we are already seeing early indications of that. For example, MakerDAO is deploying capital to invest in short-term bonds ETFs to potentially earn yield from US treasuries that we know it's around 3 to 5% in the past year. So that's very important, and I will really let people take advantage of the risk-free rate without the need to be accredited investor. So anyone can invest in this sort of product, and it unlocks liquidity where previously there was none. And it also, the last point that I want to say is that the blockchain and DeFi's infrastructure is superior to that of the traditional infrastructure. It cuts traditional intermediation layers, thus reducing the cost of capital. So with the tokenization of real world assets, for example, with what was previously securitization is now tokenization, and really has the potential to cut down intermediation layers and cut down the cost of capital for many use cases.
Absolutely, couldn't agree more. I think this is a great way to actually finish this call and session. But I want to say thank you, everyone, especially Carlos, Adrian, and Tom for joining in. I'm very excited for the next session in a month. But in the meantime, you're going to receive a lot of research from us going forward. We have a few announcements as well in the next couple of weeks, so stay tuned. I cannot say more, of course. Our comms team will be very upset about that. But if you have any questions, let us know. Thank you so much for joining. Thank you to the audience, and thank you guys, and have a wonderful day.
Bye, everyone.
Thank you. Bye-bye.
Bye-bye.
Ciao.